Good morning. The assigned topic to our group is banking and lending companies. For our point of discussion, the effects of COVID-19 on the presentation of financial statements made by banking and lending companies.
Introduction that talks about the background of COVID-19 pandemic and the background of banking and lending companies. Coronavirus disease 2019 or COVID-19 is characterized as a disease caused by a new coronavirus, now known as severe acute respiratory syndrome coronavirus 2, which was first identified in Wuhan City, Hubei Province, China, in the midst of an outbreak of respiratory disease cases. On December 31, 2019, it was initially reported to the World Health Organization, and they declared the COVID-19 outbreak a global health emergency on January 30, 2020. The World Health Organization announced COVID-19 to be a global pandemic on March 11, 2020. COVID-19 affects everything, not only Philippines but around the world, and because of this pandemic, banking and lending companies are also affected. A financial intermediary that accepts, transfers, and most importantly, creates deposits is a common concept of a bank, where this encompasses depository institutions such as central banks, commercial banks, associations of savings and loans, and joint savings banks. Banks are structured in corporate form most commonly and are owned either by a private individual, states, or a mixture of private and government interests. While non-corporate banks like sole ownerships and partnerships are found in other nations. Only a few states permit non-corporate banks to be established. All countries subject their banks, however owned, to regulation and supervision by the government, usually carried out by central banking authorities. On the other hand, thousands of years ago, the history of loans started with farmers using seeds and grains to borrow capital and livestock as options for repayment. Since then, before progressing into a new, automated method in the digital age, the lending process has developed into a complex financial procedure. To discover what lies ahead, the path of business loans is the key. Here we will take you through a brief loan history and outline the key turning points that influence the demand for lending that we see today. The history of lending has taught us that without loans serving as the igniting fuel, civilization's tremendous progression would not be where it is today.
Going concern. The going concern is an accounting term for a company that has the resources needed to continue operating indefinitely until it provides evidence to the contrary. An accounting assumption indicates that a company will continue in service for the near future is a going concern. A wide range of factors such as actual and planned viability, loan reduction timeliness, and future sources of replacement funds and the capacity to continue delivering service should be taken into account of going concern. So in general, this ensures that for the near future, there is no possibility of liquidation, which is generally considered to be a 12-month period. In the other words, even though events do not suggest changing future, events during subsequent event period, events should also be implemented into the evaluation of the current problem. For example, if we believe that a bank will not be able to function in the near future due to COVID-19, so why we are going to prepare or accrue anything? If we believe that a bank will run long enough to know this potential cost, we will not compensate or accrue anything in advance. Asset impairment, fair value, and recognition. This factor affects the individuals to generate cash, making it more challenging for customers to pay their outstanding balances, creating additional credit risk. If a scenario exists that allows the commodity to lose value, company assets should check for damage and An impairment loss is recognized and sustained to record the asset revaluation when a commodity has been revalued. The market valuation fluctuations are regularly measured. Certain intangible properties are checked for deterioration on an annual basis, such as goodwill. The trade and other debtors, contract assets, lessor receivables, related party receivables, loans advance is one of the affected in impairment factor, which is the willingness of the counterparty of an organization to repay its accrued balances owed to the entity is directly related to the capacity of counterparty to produce cash. Also, the non-current assets property, plant and equipment, intangible goodwill, lease right of use, asset cash generating units, accounted investees, deferred tax assets, and insurance receivables are belong to the items that affects the financial statements. It is because banks experience more loans than in the previous year because of the COVID-19. Most of the companies request loans or borrow money to the banks to save their business. It simply means that nowadays banks are the option of the business owners to lift up their business as well as the government. They also lend money to the bank for them to be able to provide the needs of the people. Like now, we are all in tough times because of our economic status. Some of us, some of our family members lose their job, so that some of us tends to borrow money to provide our stuffs and needs for our daily life.
Under the provision and liability is the restructuring and employee benefit cost. One of the impact of COVID-19 to banking and lending industry is the additional cost incurred for restructuring and employee termination cost. Because of the restriction to operate in the first phase of pandemic, many banks and lending companies are forced to terminate some employees. That leads to incurred additional cost, which is the termination benefit fee. This additional cost will be reflected on the financial statement of the company for the current accounting period. Another impact is the remeasurement of financial guarantee contracts. Financial guarantee contract is a contract that requires the issuer to make specified payment to reimburse the holder for loss it incurs because a specified debtor failed to make payment when due. Usually, banks and other financial institutions are the common grantor of financial guarantee contract. It is initially measured at fair value, but due to the outbreak of COVID-19, risk default are expected to become higher. That will result to an increase in amount of expected credit loss. Because of this increase, financial guarantees are required to account the contracts at the amount of expected credit loss instead of its fair value or carrying amount. Under other areas of recognition and measurement is the variable consideration. IFRS 15 requires that variable consideration in banks and financial industries shall only be included in transaction price if the amount of revenue recognized is highly probable that it would not be subject to significant future reversal when an uncertainty is resolved. But due to the outbreak of COVID-19, variable consideration are needed to be reviewed by the management. A reversal of revenue may occur as these variable considerations in bank and financial industries like performance bonuses, penalties, and structuring fees are remeasured that may result in negative revenue for the current reporting period of the financial statement. Hedge ineffectiveness. A bank using hedge accounting can impact on the timing of recognition of gain and losses from fair value changes in hedge item and hedging instruments. If due to COVID-19 impact, forecast transactions are no longer highly probable, they do not qualify as an eligible hedge item, then hedge accounting must be discontinued. With the balance of the cash flow hedge reserve treated as follows. If the future cash flow are still expected to occur, the balance in the cash flow hedge reserve remains until the future cash flow occur, and is then recognized in the same way as for the qualifying hedge item. Or, if the hedge future cash flow are no longer expected to occur, the balance in the cash flow hedge reserve is immediately reclassified to profit or loss as a reclassification adjustment.
Under the presentation of areas, in preparing of financial statements, it is important to include reliable and sufficient facts to investors and users, a reasonable view of an entity's performance and role, and the integrity of the disclosed information that adequately reflects management's assessments and estimates. Some investors are looking for the reported financial statement when making a decision, which means the information provided on financial statements is transparent and can be understand the current position of the entity. In terms of disclosure, failure to disclose information can be significant. In particular, the banking industry affected by financial risk management. Credit scores and review must be revised on a daily basis to reflect declining credit standards in certain industries. With regards to fair value, risks such as higher uncertainty, elevated risk, cash flow estimates, assets and liabilities fair value may have changed substantially. As to going concern, if the banking and lending firms believe that the going concern basis is sufficient, they should report any material ambiguity that may have a substantial effect on the entity's ability to function as a going concern. Proper disclosure help users of financial statements understand the effect of COVID-19 on banking and lending companies.
The pandemic brought upon some changes in the presentation of the financial statements compared to what it used to be. Due to this reason, there are some changes that are needed to be considered and reflected in the actual presentation of financial statements. COVID-19 has affected factors that drive the operation of banking and lending institutions such as currency risk, credit risk, cyber risk, liquidity and market risk, and the profitability and capital adequacy, all of which have significant impact on a banking and lending institution's presentation of financial statements. These factors would also affect future forecasts. The relevance of the use of forecast extends to its assessment of impairment of assets, both financial and non-financial, deferred taxes recovery, and assumed credit losses. This now leads to the question, what is the gravity of the effect of COVID-19 on the presentation of financial statements made by banking and lending institutions, and what is the effect of COVID-19 to the future presentation of financial statements to be made by these entities? To answer the first question, the pandemic caused by COVID-19 severely affects the presentation of financial statements that will be made by banking and lending institutions. Since the events brought upon by COVID-19 had an impact to the flow of market, it negatively affected the presentations of financial statements, for there will be adjustments and changes that are needed to be done and applied. The reporting of financial statements in the unforeseeable future will surely be affected by COVID-19 as well. A reproving assessment of whether COVID-19 will have an impact and adjusting periods and events should be considered. Comprehensive disclosures may also be required to be stated. The impact of COVID-19 on taxes are needed to be assessed for operations and business continuity to maintain a strong oversight on the entity's tax affair. Lastly, in order to have a proper presentation of the company's financial statement in the future, a review of management's going concern assumptions is needed. This concludes our topic, the effect of COVID-19 in the presentation of financial statements for banking and lending companies. We hope that you have learned something. Thank you for listening.